So great to have you here, Eric. So I'm going to tell you some things that are on the Cooley site, and then I'm going to tell you some things that I know. So Eric practices general securities and corporate law and focuses on growth companies, right? So he's done private financing, IPOs, mergers and acquisitions, and he works with companies a whole variety of ways and a whole different areas of interest. For instance, hardware, IoT, software, ed tech, clean tech. Basically, if you got an interesting, innovative technology, he's a guy to go to. And he also works with a number of the incubators, both in the US and abroad. But I'm going to tell you some things that, so he has experience representing and advising small and large family offices. But one of the things that's not on Cooley's site, I believe, Eric, you worked with Sergey Brin's family office for about 4 years, 3 or 4 years, correct? Yeah, so if you know Google, right, Sergey Brin, so he's got some deep insights. Anyhow, he was a business center of the Santa Clara Law Review, which is a very prestigious position. And if you look at Cooley, they are globally one of the top law firms dealing with startups and tech stars from around the world. So he also was nominated as one of the top attorneys, a super lawyer, and a rising star in 2015. So with that, Eric, thanks for taking your time. Thanks for joining us today.
Thanks, Gary. Appreciate the intro, and welcome everybody. Looks like we got a pretty large group today. And I do want this to be interactive, as Derek mentioned. I'm going to go through a lot of materials here, a lot of different statistics and market trends. And it'd be great if you could, in the chat, ask any questions that you have, so to make sure that we hit the topics and we double click on the issues that are important to you. Just a quick little background, just to extend what Gary said. I work with mostly private companies at this point in my career. I've done more than my fair share of IPOs and had a lot of public companies, but at this point in my practice, and I started in '99, I'm focused on emerging companies and representing investors in those emerging companies, as well as a lot of family offices who are investing in those companies as well. So with that, I'm going to jump into a deck that I have here, and I'm hoping I can share a screen, and let's make sure that you guys can. You guys see the slide deck? I should say, Gary, can you see
it?
Yes.
Yeah. So we see it clearly.
Okay, great. Okay, so just a little kind of topic overview. We're going to look at some trends, and then we're going to talk about the types of way to raise money. And there's a lot of great ways, and I know a lot of you are experienced with some of these convertibles that are outstanding these days. Then we'll look at timeline and process, and then maybe talk a little bit about term sheets. And again, I do want this to be kind of an open topic discussion, so there may be other things that we talk about and kind of discuss as part of this, but would like to share with you what we're seeing. And so one of the things that that is a great tool for not just clients, but for everyone who is looking to raise money, whether you be an entrepreneur or an investor, is to look at our trends that we actually publish publicly on CooleyGo.com. So if you want to split screen and have me on the left side and look at Cooley trends or the CooleyGo trends, feel free to take a look at that. I'm going to go through that data today. And it goes through kind of a host of different items that we see in term sheets, we see in NVCA documents, we see in deals, and we consolidate that, do analytics on it, and provide it on a blind basis to the public. Obviously, we have even additional data behind the screen that we share with clients. But this is actually great for those of you who are wondering, hey, I wonder what market is. I wonder what Series A valuations are. I wonder if this is a normal term. Is it an accruing dividend, something I should agree to? I did, like I mentioned, I started practicing a long time ago before any of this data was actually available. And so the real way to kind of get market data was to call up, your 3 best friends at the local venture capital firms and see what deals they've done lately and see if markets were trending in any particular direction. We're doing between 300 and 400 deals a quarter, and that's why most of our information is produced on a quarterly basis, while some of it is based on a monthly basis. But it's very interesting to see kind of where deals and the market is trending. As you all know from looking at Yahoo Finance, you can tell that the public markets are not doing as well as they have been in the past. That's having a trickle-down effect to our crossover, SPAC, and pre-IPO deals. We're seeing kind of a general delay on most of those deals. The good thing is that it hasn't trickled down all the way to the kind of seed Series A, Series B side. That's usually 6 to 8 months delayed from the public market. So we haven't seen that downward trend. And so as you can just see as the deal volume and moving average here on this first slide, I think this is another indication here on this next slide about how the market has been trending up generally through kind of the middle of last year, with a lot of deals getting done, a lot of money being invested. And these are all the trends that we like to see. As you will notice, we go through this data, we're seeing some sluggishness in Q4 of last year and Q1 of this year.
Hey, Eric.
Yeah.
One quick thing, sorry to interrupt. Can you maximize the slides? We had a request so they could see it. I just didn't want to interrupt you.
Why don't I do this? Does that help?
Yeah, that's great. Thank you.
Great. Yeah, I'm the same way. I've got this laptop at home, and then I've got my big screen on the left. And the unfortunate thing about COVID in the last 2 years is now I have reading glasses. Don't know if anyone can sympathize, but that just is either a sign of a small computer or my old age. So I actually look. This is a slide I look at kind of constantly, even though I'm in it day in and day out. You know, at any given time, I probably have between 5 and 10 financings going on. But this is a slide that I'm always very interested in looking at. As you can see, you know, I almost don't like having the Series D as part of this, and so I've removed that in this next slide. And I think that's a little bit more interesting and a little bit more helpful to the folks on the phone, because we're dealing with early stage deals. As you can see, the seed and the blue line, which I think is really the line that you want to focus on if you want to get an accurate picture of kind of where the market is, because by the time you get to Series B deal, that's usually based on a revenue marker, where Series A deals are based on a market marker. And so I think the blue line actually is the most interesting of the lines. And as you can see, you know, back in the day here in April of 2020, we were in the $30 million range for pre-money valuations on the Series A. As you can see, as it trends here, we jump over 50 in the May-June timeframe. And then by September, it's actually up to 75 million, which in my mind is really impressive or ridiculous. That you can use your adjective, but that is an impressive increase over just a year and a half of where we were. And then even before this to 2020, you know, we were looking in the high 20s, low 30s. And so just over the course of a year and a half, we're now looking at mid 70 valuations. And I can tell you the data has already come out on the end of Q4 and a little bit in Q1. We're seeing Series A dip down into the mid 50s again. So I think the mid 50s is going to be where we're going to settle for Q1 of this year. But we'll see how that plays out since we have another month or so.
Hey, Eric, Umesh, a quick question here. What do you attribute this change to? Is it because in this period, companies have generated certain levels of revenues or market receptivity is good, or is it just financial engineering that somebody thinks the value of X has gone to Y? What do you think is the primary driver?
Yeah, it's a great question. So the answer is yes. It's all of those things. But the way and the reason why I started by saying I like looking at the blue line as opposed to the orange or the dark blue line is because a lot of time it's just market. There is no revenue in some of these companies, or the revenue is just beginning. So it's not a multiple on revenue to arrive at a valuation. You're looking at the TAM, you're looking at the market, you're looking at the founders, you're looking at the idea behind the company, and you're saying, okay, what's the rest of the market doing? As opposed to, hey, you've got $1 million in revenue. Should I do a multiple of 10 or multiple of 15? How do I get there? Because companies, it's just a little too early. That's why when you get to the Series B line, that's more a financial model metric as opposed to the blue line, which is a market metric. So there's a bunch of different things to look at, but this is why I think this slide is so powerful for entrepreneurs to say, okay, I think my IP is pretty cool. I think I got a good team. I think I got a good idea. Obviously the market's big, whatever that is, it's easy to do a TAM analysis. So what are other companies in this space? And if you go to Cooley Go, you can actually, pull out some separate verticals, whether it be life science or technology. But what are other companies in my kind of time frame, meaning Series A-ish companies with a new company, maybe no financial history to speak of? What are they getting? And so the real market indicators are, okay, what are VCs willing to pay, and how competitive a market is? It's very competitive, and that's why we see deal valuations going up increasingly over the past year and a half. It's just because it's a competitive market, and what are people willing to pay? I can't tell you how many cocktail hours I've been at where people are scratching their heads going, did I just do a Series A at 75 million pre? Did that just happen? And these are venture capitalists speaking, and I jump and I go, yeah, you did. And you're not alone, because that's actually the median or the average in the last quarter. So you are actually just doing an average deal, 75 million pre in Q3 of last year. Now, I think that's going to settle down a bit. I think those valuations are difficult. And there's a lot of extraneous factors out there. We've all been watching different cases in the news about different companies that perhaps investors maybe should have done more diligence, whether on the business side. And so we're seeing longer time periods for deals right now. And we're also seeing a lot more cautious investors in Q1, just given liquidity concerns on the public market. So I think, not that I think, I know that blue line will be headed towards the $50 to $55 million mark for Q1 2022. Good news, bad news. The good news is that's still super high historically for young companies. Bad news is it is trending down as opposed to trending up. But I think even in the 50s for a Series A valuation, that's fantastic. And let me speak kind of from a 30,000 foot view. What does that mean to you as a entrepreneur? Is that dilution is not as big a factor as it was 5, 10, 15 years ago. So let me go back in time where, 2005, 2010, we would run dilution models for our clients because they wanted to know how much money would I have after my Series D offering, or how much equity would I have when I go do my final offering on the private side and when I go public. And the answer was most founder groups had well below 50% of the company when they went public or had a liquidity event. At these valuations and at the money folks are raising, that is not the case anymore. Founders and founder teams have over half of the equity in companies in a lot of circumstances. Not every circumstance, but in a lot of circumstances. And that's primarily driven by valuation. So I'm sure there's going to be a question there, and I don't have the chat room open, and Derek, please keep me honest.
So I got a couple. I think one of the questions they have, and maybe you could elaborate, is that Series seed line. So what are the median valuations that you're seeing for seed?
Yeah.
And maybe the answer is go to Cooley Go.
Yeah, let's
which
bring
is
it up
cool too.
right here.
Yeah, so I think
there you
everyone
go.
needs to record this website for some of these questions, because you could really do it yourselves. But go ahead, Eric.
Yeah. Well, I just brought it up. Hopefully you guys see that. Sorry.
Yeah, no, it's great.
I am on the Cooley Go website here, and you can see that it is 18.7, and it's gone up from 12, right? So as you see the blue line go up, you're going to see the orange line go up. I think is the way to kind of think about this. And so what we're seeing in seed deals, and these are priced seed deals, I should mention, and I'm going to get to this later. because I think the next question will be, what should I think about valuation caps in my convertible notes or my safes? And I'm going to get to that a little bit later. But depending on how far you are from incorporation and how close you are to a price deal, that's what's going to dictate your valuation there. But as long as you see that blue line trickling up, you're going to see this line trickling up. Now we're seeing the C deals just taper off a bit because this balloon line actually in the next few months is tapering off as well. So there is a strong correlation between the two.
Eric, another question that people have, and I don't know if this is on the website, but what is the average dollar figures you're seeing raised with these valuations?
Yeah, another great question. So what I like to advise my clients is I like to see somewhere between 15 to 20% dilution on every round. If you can do less than that, that's great. But there's a couple of other different factors. So that's kind of the 30,000 foot view. The factors dictate how much money do you need, and think kind of on a temporal basis, to get through the next 12 to 18 months. But in reality, you're building enough money, or you have enough money in your coffers to get to the next milestone event where you can say, hey, my valuation used to be 30 million. Now it's 60 million. What have I done with that capital that I just raised to get to a milestone where I can defend a markup of 2 to 3x of my valuation? So you have to have a milestone event in mind that's going to get you there. You also have enough money to get 6, 12 months into the future, because usually companies are raising on a 12 to 18 month, maybe 24 months schedule to raise, depending on how fast you're scaling. But that's the amount of money and the dilution you want to think about. So in my mind, I'm going, okay, I got a $40 million valuation for my Series A. I'm looking to raise somewhere between 8 to 10 million, to get to that 20% dilution mark. Maybe I've got a huge option pool increase, so maybe I'm not raising that much, but I've got to think about how much money I need to get to the next round. So if I'm thinking, all right, 10's not going to cut it, I'm going to need 20 million. Well, you really should then go back to your valuation and think, okay, maybe I need to increase my valuation so I'm not taking a 30% valuation hit, dilution hit. Because as a founder, you're always looking at dilution. Dilution should always be in your mind. Dilution is not the only thing, but if you're thinking, okay, wait a second, do I want to take a 30% dilution hit? I'd say pause. Maybe let's raise half as much money today at that valuation. And then in 8 months, we go back out and raise money at a much higher valuation and raise that additional 8 million or whatever you need, and take a much less hit on dilution. Does that make sense, Derek?
Yeah, no, that's great advice. And one other question that I think is relevant, and I don't know if this is on the site, about demographics. Would you say this is what's happening in California, or would you say this is globally applicable? Like, how do you guys view that in your data?
So this is all through the United States. We do on Cooley Go allow you to bifurcate the data between East Coast and West Coast. On valuations, it's only slightly different. And then I could also speak globally too, because I have that information as well. Valuations in the US are much higher than in Europe. It's almost to a 2x difference. It's about 1.5 to 2x. The market's just not as entrepreneur friendly in Europe. East Coast versus West Coast, valuations are similar. They're a little bit higher in Silicon Valley, but they're similar. In reality, the big differences on a percentage basis between East Coast and West Coast are some of the terms. And we're going to get to that in a second. But these are the data I'm handling here in front of you is US data. And for the most part, you can take it it's a national average as opposed to a regional average. But I'll note the differences later, where there's definitely a difference between regions. And that gets into some of the terms, notably redemptions and a cumulative dividend. I saw a question here about the raise, is this 3 to 5? That goes to my dilution question. So you're looking at, 10, 15, 20% dilution per round. So if you do the math, depending on your valuation, you're probably, $40 million valuation, you're looking at probably an $8 million raise, somewhere around there. A little less if the valuation was less, a little more. And, I don't think I'm shedding any super secret information here. Maybe I am, but a lot of the time venture capitalists kind of back in to how much they want to invest based on the valuation, and going, hey, as a firm, I need to own X percentage of the company. And so therefore I'm going to write a check of X because the valuation is Y, and they have a formula there. Not all venture firms do that, but that is a metric that a lot of firms use. And so when you go into negotiation and you're thinking about valuation, you should really think about, okay, they're going to at least need to own probably 10% of the round. So they're going to write a check of at least 4 million, maybe in the $6 million range. And maybe you have some friends and family, they're going to make up the rest, or you want a co-investor. We'll get to that on terms, because I'll always recommend having multiple investors, not 100, not 20, but if you have 3 or 4, think about voting percentages, think about consent rights, think about those things where you'd love to have consensus of the majority as opposed to just one person having a veto right. Okay, I'm trying to scroll through the questions here as well.
There was a question about why valuations are highest in the US. I mean, I think that's kind of a broad question.
Yeah, you know, I'll give you my thought on it. No, by no means is this the right or accurate or certified answer. I just think that the venture community is mature, and there's also a large number of venture capitalists, not only in Silicon Valley, but throughout the country, you know, in any jurisdiction or any region. And they're actively investing in the private markets, and we have a robust securities exemption, excuse me, for making those investments. And we'll get into this in a second, but we also now have these convertible securities like safes, convertible notes, and seed rounds where people are making investments kind of all the time. And then we have Reg CF, crowdfunding, which actually is available in Europe as well. But we do have it in the US too, and that's allowing a lot of investors. And then of course, all the cryptocurrencies and different token offerings that are out there has just made our market a little bit more robust, just like, you know, Nasdaq and NYSE in terms of investing. And therefore, I think because of that, there's a little bit more, and I should mention, and we have the largest number of entrepreneurs by far who are starting companies with new ideas, and therefore their demand is up, there's a lot of activity, and valuations are going up because the market's been going up. I actually, you know, given where the market's going today, I think we're gonna have some more symmetry between Europe and the US, but I always think US has been a little bit higher than Europe, just because I think the marketplace is bigger. That's my take on it. Again, by no means is that the right answer. Remember, I'm a lawyer, not an economist, so I'll put that as a disclaimer out there.
I think that's
my
good.
answer. Maturity, competition, laws. Yes, Derek, I'll go with that too. I like all those.
Maturity, competition, and laws. I mean,
Yeah.
That's just the reality. And I think it is, competition globally is expanding, and you're starting to see more and more. You used to see, you know, $3 million valuations in Europe, and now they're getting much higher. So I think it's going to get better and better. But I think the valuations in Bozeman, Montana are not as high as in San Francisco because the market's not as mature for startups. So.
Yeah. Right. Yes, I think that's right. Let's go.
I think we're good, Eric. I think we can go to the next one.
Yeah.
I'll come back
great.
to Sevy's question.
Risk profile. Yeah, and I'll get to that in a second. Pre-money valuations on over $100 million deals. Yep. There you go. Obviously going up. We'll see if that goes down. Median amount raised. I think this is kind of getting to one of those questions that was raised earlier. You can then, you know, cross examine the data about how much money was raised on each of those deals, and really you want to overlay the valuation on this slide to kind of get exactly where you're headed. I always think this is interesting, especially since I had to practice law during the period from 01 to 03 and 08 to 09, where you might have seen that red line and that dark blue line somewhere in the 30 to 50% range. So this is, it's funny, you know, you look at the macro economy, that's what you see. If we were going to have a course correction, either an 08 financial crisis or a dot-com crisis, you'll see flat and down rounds just kind of proliferate through the venture community. Obviously, we're seeing a very small percentage of down rounds or flat rounds for that matter, and most are up rounds. So that's great news. But again, we're probably going to see this line slope down and these slope up a little bit over the next quarter.
Could some of that be because entrepreneurs have kind of learned that down rounds are a bad idea? Or do you think it's just the market?
Well, actually, Derek, that's a really, really good question. The entrepreneurs that we're working with, and of course the ones on the phone, are so much more educated on these business metrics on financing agreements, where there's the Cooley Go tools out there, but there's also these CEO networks. There's great incubators out there, obviously, where they just get educated and they go, okay, I need to raise money in an appropriate way. I don't want to raise money let me just squeeze out at 150 million when I don't know if I get 150 million valuation the next year, and being strategic about raising those money in the terms that they should raise at. And I think that education piece about how they think about the overall kind of pathway for financing over the next 10 years as opposed to the next 2 years really determines that founders aren't going to go raise money doing flat or down rounds. Flat rounds actually not that big a deal, but a down round, not only, even if it's still a good deal, it just doesn't have the right PR effect. And folks are going to be questioning the company and the direction it's going in. And I think founders are just smarter about that. So yeah, I think that's.
Hey, can I ask you a question about that? I don't know if you're going to elaborate on this, but I'm seeing some of the companies I'm invested with where they really do plan it out, assuming each round needs to generate a triple. And so backing, coming back from total size of market and valuation at exit, they're thinking through, how do you give a triple each time?
Yeah. And when we do dilution scenarios for folks, that's exactly what they're thinking. There's either a 2 to 3x per valuation per fundraising round. And people, do that at the beginning. Now, does it always work out that way? Obviously not. But yeah, a lot of folks ask for that when we start companies to think, okay, if I'm raising at 50 today, I'm going to do 150 for my B and I'm going to do 800 for my C. What does that look like? And if I'm raising 10% or 15% at each time. But yeah, a lot of people are asking that question. Okay. I'm going to get into a little bit of more of the granular details here. And if people are getting super bored, just say, Eric, it's not cool. I don't want to hear this stuff. But we do track like the major terms within these documents, and liquidation preference actually means a whole lot more to entrepreneurs because first they know about it. But when you have liquidity event, especially an acquisition as opposed to an IPO, liquidity preference matters. And what we have now is that, the preferred get 1x out first, and then everyone else gets their money. There's no 3x to the preferred. There's no full participation where they get their money back, then they participate on an as converted basis. You're looking at this where it's close to, 96, 97%, where there is no additional liquidation preference going to preferred. It is a 1x cap liquidation preference. Yep. Okay. Saw that note. So on the pay to play, that was always a fun term, especially 02, 03, 04, a little bit in 09. I see it once a year now, maybe. And for those of you who are not familiar with the pay to play, this is a penalizing way, or it could be an incentivized way to tell your insiders, you better participate in this next round, or something either bad will happen to you. Your preferred converts to common, or sometimes you flip it and say, if you don't participate, you won't get the benefit of having a super low valuation or getting 10x warrant coverage or something, ridiculous where you get diluted. So you're trying to say, hey guys, everyone come to the table and participate because we need money. We're in a kind of a difficult position. And that's when you see these pay to plays. And as you can see on the left-hand side, we're south of 5% on pay to plays. And then we, extrapolated that data just to show you, you're probably going to see pay to plays at more of the later stage deals than the earlier stage deals, obviously, because at that point you do have insiders and you're starting to get creative. But it's a very minority of cases, so we won't spend a whole lot of time on it. Drag-alongs, again, it's a super material provision, especially for entrepreneurs who now have investors on board, and on board figuratively, literally, they're on the board of directors. So what is going to cause everyone to agree to sell the company? And there's all these nuances. Should you have a cap with a sunset? Should we do, is there a spread that would there allow some veto right? But essentially, I would say the large majority, first of all, the large majority of deals have a drag along. And the drag along states that if a group of people, usually the board, a majority of the common and a majority of the preferred stock, so just a majority of the board, majority common, majority of preferred, agree to sell the company, the drag along in the voting agreement, which every investor signs and all the large common stockholders typically sign, would state that you must vote in favor of that deal. And why do we like that? It's so that you cannot exercise dissenters' rights and or object to the deal and sue the company. You are forced to vote in favor of the company. And typically, when I either represent acquirers or companies on the other side, acquirers like to see somewhere between 95 and 100% of all stockholders approve a deal because they don't want to take on the risk, or even if they push that risk to the target company, they don't want to have the risk outstanding at all that someone's going to dissent, go to court and say that the deal wasn't high enough or the value was not incorrect or some fiduciary duty breach, and exercise those dissenters' rights. So drag along is super important, both for entrepreneurs and for investors. Sometimes you see investors go, well, I want a veto right unless the deal is over 100 million or something like that. Those sometimes get negotiated, but as you can see here, almost every deal we do has a drag along in it and a voting agreement. And let me point everyone to another site. If you're super bored and you really want to go to bed quickly, go to nvca.org and start reading through the form financing documents that are used in 9 out of 10 deals these days. And it has all the 5 important financing documents that are available to the public on that site. And those are the documents that are traditionally used by most investors. And,
can you type that in the chat, Eric, for everyone?
Yeah, right. Yeah, nvca.org. Let me make sure I'm not chatting the whole group. There we go.
It's National Venture Capital Association.org, nvca.org.
Yeah, yep. And the board of NVCA is made up of a lot of the most famous venture capitalists out there, along with the law firms that are traditionally doing deals, are advising on all of those agreements. Delaware Council is constantly looking at those. And so those are being updated quarterly. We're on the advisory committee, so we see and help with the changes to those documents, but we live and breathe those documents every day. I won't spend much time on this because obviously this doesn't happen a whole lot of time, but the recaps go along with pay to plays where things aren't going well. And obviously we're mostly early stage companies on the phone here, and we're all going to do well. So who cares about these, right? I will mention tranche deals just for a second. As company counsel, I traditionally don't like tranche deals. And that means that someone goes, hey, I'm going to give you $5 million, but I'm only going to give you 2.5 now, and then I'm going to give you 2.5 when you reach a certain metric. And don't know what that metric is, or well, let's define what that metric is, and it's X amount of revenue or it's X amount of customers, blah, blah, blah. Well, that just puts additional risk into the deal. And so as you can see from here, tranche deals happen in a very low metric for tech companies. But if you're a life science company, sometimes they say, hey, when you get clinical results, when you get FDA approval, they're a little bit more prevalent in the life science deals. So you may or may not see it, but if you can avoid it as an entrepreneur, I would avoid it unless you're pretty much 130% sure that you're going to hit that metric. But that money is not in your account. It doesn't even come into your account until you hit that metric. And then the additional risk is, what if that investor has liquidity issues? What if that investor invested in, that crappy, cryptocurrency that went to zero and now they have no more money? So these things that they're outside of your control. And so you want the money in the bank today. And I would actually take a lower valuation. And I'll even mention something else here that I'll get into a little bit later. But or hopefully get to later given time, is that the valuation shouldn't be the only thing that's on your mind. You want to make sure that you have the right partner when you bring on an institutional investor. And by partner, I mean literally the individual who's going to be in the boardroom with you, who's going to be, the person you call on Sunday evening when you've got some huge problem, that's going to help you navigate different strategic deals. That's the person you want on your board. And if that person is only able to give you a valuation of 100 and some other firm's giving you 110, but you don't like that person, time and time again, that small dilution is going to pay off at the end of the day if you have a really good strategic partner on your board. So that's a little bit of non-legal advice right there, but I see that come up from time to time. Hey, Eric, who should I go with? And go with a partner that you want to be, that you want to have next to your side for the next, 5-10 years, because it's a long ride. It's not a 1-year thing, although some companies, get bought and sold in a year. But most of the time, it's a kind of a 5-year journey, and you want to make sure you have a solid partner on your side. Yeah, I'm going to try and speed up a little bit here, because given that we only have 20 minutes. Okay, so just a real quick question. Take any offers. I'd love to have a strategic investor or partner. Yeah, let me just spend a second on strategic investor or partner. So there's your traditional venture capital institutional investors, and you can argue that they're all strategic in nature because they have certain connections, they have certain other companies in their portfolio that may make sense for you and for certain strategic deals in the future. But then there's a kind of what we do call your typical strategic investor, which usually is a competitor, not a competitor, a customer, or a person in your vertical, and by person I mean company. And you have to think about how close do you want that company to you, because will it persuade others not to use you as a customer or invest in you because they think that you are partnering up with a potential competitor of theirs. And so when we think about strategic deals, we always like to get a financial institutional investor in first, and then think about, okay, let's go maybe out to strategics. And then we have to think about what the commercial arrangement, whether they want exclusivity, whether they want some price reductions, whatever it is, and think about the business deal that goes along with that, as well as how does that work with the macro business outline for the next 2-3 years, and whether or not other competitors out there might be angry that we went with company A as a strategic and not company B, or that we have any strategics at all. So it's a little bit difficult to kind of generalize strategics, but strategics can be interesting, if not difficult, when you bring on strategics. Actually, I don't think I talked about anti-dilution. Let's just really quickly. Broad-based anti-dilution, it's used literally almost 100% of the time these days. We don't have to talk about full ratchet, which is essentially saying, if you sell stock below my price, I get the benefit of that next price. Therefore, if I bought 1 share for $1 and you sell it at 50 cents, you're going to give me 2 shares when you do that deal. So you're going to give me an extra share. Okay, so this is the one I wanted to talk to you guys really quickly about, geographically, kind of the big difference between what deals we see in Silicon Valley versus really the rest of the country, but mostly East Coast, is that we have a little bit of a difference between redemptions and accruing dividends. And if you see accruing dividends, they're kind of coming to a head here where accruing dividends are not happening. But redemption features, I used to have them in all my deals back in the 2000s. They're just not prevalent at all, but it basically says, hey, in like 5 years or 7 years, if I'm a preferred holder and we elect to have our shares redeemed, you will buy our shares back at a certain price over 3 years. Companies don't like to sign up for that. The reason why investors wanted it is they wanted it to guarantee liquidity because they're investing in a private company. Those have largely gone away. And then the accruing dividend, and I am talking about venture deals here, not private equity deals. Private equity deals, this would like literally be reversed. This is for venture deals, accruing dividend, meaning, hey, put a 3% pick on my preferred stock. So every year I'm getting a 3% return. So when there is a liquidity event, whether it be an IPO or an acquisition, you're going to give me the benefit of having that 3% pick kind of over time. So I'm going to get either additional liquidation preference or additional shares at the time of the IPO. Again, as you can see, that's in virtually no deals. I see them in European deals still, and occasionally on an East Coast deal. I just did a deal in the UK, had a pick. It was literally, they said it's absolutely standard. I had some data to refute that, but I do see them a lot on UK deals. All right. So I don't know if there's any more questions on the
I
data.
keep going. I think on the safes is really interesting for them.
Yeah. Okay. So let's keep going. We got just under 15 minutes here to talk about equity rounds versus convertible securities rounds. And convertibles, I mean safes and convertible debt. And so I'll just back up a little bit here to give the history. Traditionally, I don't know, last 30 years, I guess, or so, convertible notes have been used predominantly in the past to raise money when people didn't want to talk about valuation. Company was too new, or frankly didn't want to take the time, and I just want to put money into the company, trust you entrepreneurs, you guys are doing a great job, not gonna do a lot of due diligence. Here's $100,000 or here's $1 million. Let's just have it convert at the next round when an institutional investor comes in, and we'll let them price the deal. But hey, you know, since I'm coming in early or earlier than them, let's build in a discount, right? So, you know, the biggest term in these agreements is this discount feature. And before I get into that, the reason why folks are doing that is because what I just explained is set at such a lower cost. In fact, on Cooley Go, we have a generator generating the notes, the safes. Y Combinator is another place that generates the safes because they actually came up with the concept. And safes have, are now used. And I would say it's still 50-50. Sometimes it's a little bit more often. Safes are used. Sometimes it's more notes. It just depends. But the reason why safes were created was that entrepreneurs were not comfortable with having a huge amount of debt on their financial statements right off the bat. And that's what the convertible note was. It was debt. It had an interest rate. It had a maturity date. Sure, it was going to convert, but it was debt. And so SAFE, which is an acronym for a simple agreement for future equity, was created. And it's a kind of a pseudo equity instrument that works very similar to what the debt instrument did, but it's not debt. It does not have a maturity date, or it can, but it doesn't have to have one. And it does not have an interest rate. It's not, since it's not debt. So that's not mandatory. So safes have become maybe the preferred instrument for early stage companies. And I'll also say this, I've got a lot of late stage companies that are using safes now too, because they don't really want to discuss valuation. They're waiting to go to the public market. So they say, hey, here's a safe, put 10 million bucks in and we'll do it at a 10% discount to the IPO price, convert it. So it's not only an instrument for early stage companies, but we'll talk about that today. So the big things in a safe and a discount, the two biggest items, and there's really four, but the two biggest items are the discount, which I agree with, but I do these talks to a lot of groups, and philosophically, I actually, and if there's any investors on the phone, please feel free to come and argue with me or tell us why. The valuation cap is necessary, because the reason we get into this whole convertible security discussion is that no one wants to value the company. So let's not value the company. Let's put a discount on coming in earlier. Let's value it later and I'll get the discount. Great. Oh, but wait, the company can't be worth more than this. So let's put that valuation cap in the company right now. Well, aren't we doing this to avoid the valuation cap? So I always, going back to one of the original questions here in the chat, which is, what are the valuation caps we're seeing in some of these convertibles? Well, shit. I mean, sorry for the French there, but why are we even having a valuation cap if we don't want to talk about it? Well, I lose that argument, 9 times out of 10. Okay, so I'm sorry for getting on the soapbox here, but I usually lose because the market says we're gonna have a valuation cap. And the valuation caps, look, there's no rhyme, rule, or reason for what that should be, other than I would not advise you to have a valuation cap that you think will exceed your Series Seed or first priced round, your Series A round, just because it doesn't look optically good. You can still do it, but it just look optically, and you can use the discount in that case. But the rule of thumb that I used to use back in the day was, hey, we've been operating for 6 months. Let's have a $6 million valuation cap, like $1 million a month, kind of. That's the rule of thumb, and I think that's gone higher now than that. But there really is no rhyme or reason. It's just kind of thinking, all right, how much time and money have we spent into it? Okay, we're going to look at our seed or our first price round is going to happen in X amount of months. Let's back into a number thinking that our first seed round is going to be, or our A round is going to be 40 million, 70 million. You look at the metrics that I showed you on Cooley Go and then back into that number. And I think that's the way to do it. It is a fantastic instrument for investors and for entrepreneurs to use, because it is literally available for free on all these different websites. You can negotiate and draft it within a matter of minutes. It's not the fully negotiated documents that are on nbca.org, which are, hundreds of pages long and take sometimes 6, 8, 12 weeks to negotiate. The SAFE can be done in a matter of minutes. You get the board to approve. If you execute, it's done in a day. And so folks have really liked the SAFE instrument. And from an investor perspective, you're getting basically a full ratchet guarantee that you're getting in at no more than that valuation cap. And even if that you don't hit that valuation cap, at least you're getting a discount on the institutional investor who's about to put in a substantial amount of money. And so the SAFE and the note have been used kind of throughout our community for the last decade, and notes even before then. And we see SAFE financings happening at a very rapid pace. And so, I would recommend that you take a look at the SAFEs that are on those sites and look at the language and see if it's appropriate for your company to raise money, since it is such a easy and cheap way to document it. And I'm seeing a couple questions here.
Eric, what about just the average discount rate? Like, is it 10%, 20%? Like, what do you see for that?
Yeah, so I'll just say the market's somewhere between 10 and 20. And the closer you are to a financing round, the lower the discount. Or the more leverage that you have, the lower the discount. But, if you're just doing a SAFE, tomorrow I'm seeing somewhere, 15, 20% discounts for, hey, I'm raising money, but I'm not doing my next institutional round for another 6 to 12 months. Then I'm seeing a 20% discount. And, arguably it could be more than that. And that's where the valuation cap comes in. If I'm doing a financing, a price financing in the next 3 months, then it's a 10%. That's the argument I would make, is that since we're so close, the discount should be lower. No limit. I see that question in the chat room. There's no limit. But that being said, going back to the discussion of your dilution model, I think one of the errors that entrepreneurs can make early on is saying, oh, I got the SAFE, I'm just going to go ahead and raise like $50 million on a SAFE. There's a pre-money SAFE out there. There is a post-money SAFE out there. Theoretically, on a post-money SAFE, you could actually sell more than 100% of the company. So if you had a $10 million valuation cap and you sold $11 million of SAFEs on a post-money SAFE, you just sold 110% of the company. So you don't want to do that, obviously. But the real lesson here is that it's dilutive, and you've got to run the dilution model based on how many SAFEs you have, which could be a substantial discount to your next round. If you have a valuation cap of like 10 or 15 and suddenly you're raising money on a $100 million valuation, I mean, those folks just got a fantastic deal. And you got to think, okay, they're going to get a lot of shares for $1 million or $10 million or however they put in at that $10 million valuation. So you got to think, oh, geez, how much does that work into my dilution model? I remember someone telling me I should only think about, somewhere between 10 and 20% on dilution. Sometimes you go to 30, depending on the investor, but I should not like have a 50% dilution event from a SAFE. Well, you may have done so many SAFEs that you do have this huge dilution event. So always keep that in your mind. Is there a rule of thumb? It just depends on how large the valuation cap is on the SAFE. But I would think of it as a round, and so it is a dilutive event. So keep in your mind that you just want, somewhere between that 10 and 20% number on dilution for that SAFE, or I should say SAFEs, plural. So that's the number you get to. It's not like 3 million, 5 million, 10 million. I think it's somewhere in the percentage basis of dilution. Yeah, okay. I just saw the chat. Okay, so just going back to the slide deck here, just to kind of mention a couple things I've already mentioned, but I say typically up to 3 million, just because it's usually used by early stage investors. And if you go over 3, and with the valuation caps we're seeing, by no means is 3 the hard number, but that means that somewhere the valuations are somewhere between 10 and 20, and you're getting, potentially 10, 20, 30% dilution there. So I say, hey, look at the dilution. It converts into the next equity round. We sometimes put in what's called shadow series. So if you do a series A, they would convert to a shadow series A1. What does that mean? That means it has the exact same rights as the series A, but the A1 have a liquidation preference that's equal to what the safe amount is. So you don't get, just because you put $1 million safe together and you get $2 million worth of shares because you had a valuation cap that was half with the price, that you don't get then a $2 million liquidation preference, you get $1 million liquidation preference because it's cash in, cash out. Often no diligence. There can be sometimes, but often, most of the time, it's just a quick, hey, I trust you, here's the safe, let's move forward. It's a simple document, it's on the generator, it's on a lot of generators. Super fast, I say 1 to 2 weeks here because I want to set expectations, but you can do it in a day. Obviously, transaction expenses are way, way, way lower. You know, I don't even want to get into kind of what a financing costs these days because it really depends on the level of diligence, but let's just say it's a lot more. Legal time, company time, your headspace, all of that going into a 6 to 8 week transaction for a priced round versus a convertible. You know, the company often leads. So, you know, you're not waiting for that term sheet, which a lot of people on this phone call may be waiting for. It's like, hey, going out to friends, family, micro VCs and saying, hey, we're raising some safe, here's the terms, you in? You know, that's kind of how it works. And so that's why it's such a great tool. Let me hit a couple of the other material terms, and I see a question says, it sounds like a perfect instrument with a disadvantage. The disadvantage is doing too much and giving too good of deals. Because I'd say half the time I run a pro forma when we're doing a Series A and we're converting all of the safes, and the entrepreneur there scratching their head going, man, I had no idea that these safe holders were going to own this much of the company, because it just never occurs to them. And the safe holder's not on the cap table until that financing. They don't, right? They own they're not a security holder in the traditional sense of owning common or preferred. They just own a safe. So they're actually not on the cap table, so you don't think about it. Same with a note, you just don't think about it. But when you do convert it, and I'm just throwing that warning out here, is that you will kind of scratch your head and go, oh, I didn't realize, because our valuation's so high, that they're getting basically 3 shares on the dollar when they should have only gotten 1. Okay, so we've got change of control multiple, and then maturity and interest rate. Maturity and interest rate, as I told you, only apply to notes, but the change of control multiple applies to safes and notes. And what does that mean? So we talk about it a lot, especially with later stage companies using safes or notes, but we do talk about it as well, and it's in the generator. It's a decision point of, should there be a multiple paid if the company goes through a liquidity event prior to the next equity round? And you know, we can talk philosophy of whether that makes sense, but I'll just tell you that the market dictates that there's going to be some multiple, whether it be 1.25, 1.5, all the way up to 2. And in distress situations, you might see 3, 4, 5 X, but saying, okay, the company has decided, not me as a safe holder, because I don't have a vote, or a note holder, I don't have a vote, but the company has decided to go liquid and not continue the business. Therefore, since I put money in, I should get a return back because I was in it for the long haul, and therefore I get 1.5x on the money. So if I put in $1 million, I get $1.5 million out. There is a variation to this, and I have to mention it only because we've seen dramatic kind of results on the variation, which is, hey, I don't need a 1.5x, or I get a 1.5x or the better of the 1.5x, and you converting me to common stock at the valuation cap. You guys are selling yourself. I have a $10 million valuation cap. You're getting bought for $100 million. I own 10% of the company. I should get 10% of the liquidation proceeds. As opposed to $1.5 million, I should be getting $10 million. And that exact circumstance comes up occasionally when we have young companies that get bought out by large acquirers early on. And if that best of language isn't in there, depending on the deal type, you only might get $1.5 million if you're a safe holder, as opposed to 10 million. So it can be a big differentiator depending on the liquidity transaction that happens with companies. So I did want to mention that COC provision, that it's in safes. We're at the hour here. I'll just throw this up there. Priced equity, as I mentioned, it's a lot longer. Usually have an institutional investor doing deep diligence, both business and legal and cap and audit, all of those things. Depending on your vertical, you might have regulatory issues. It is a much different transaction. And everyone should get their mental headspace right when you go into a financing, because there's at least 2 or 3 times where you're like pulling your hair out going, why did I decide to do this? But you still got to do it. Wait till you get into an M&A transaction. That's when you really start to pull your hair up. And then timeline, again, I've kind of hit this. This is for if you're doing a traditional equity financing, you got your term sheet, and some of you may be in this already. I still have a couple more minutes so I'll just go down to 5 minutes here, so just to kind of get through this, which is I probably get the most questions from entrepreneurs around the pre-term sheet time period, like, hey, do I go meet with investors? How do I meet with investors? Which investors should I meet with? How do I generate interest, and how do I get those investors to produce a term sheet? This is an art. There's no perfect way to do it. I will tell you, by just being on this phone call, you already have connections to folks who know people at these firms. That's one of the biggest advantages by doing these programs, is to be able to have access and friend of friends who can provide access to those folks. But I would, generally speaking, advise against doing some mass mailing, to like spamming 100 investors and saying, hey, do you want to invest? I think it is carefully crafted discussions with targeted investors that you have done research on, who are interested in your area, maybe other companies in your vertical, who will be promising and helpful partners throughout the life cycle of the company. And those are personal meetings you need to have with those investors. I would never advise you to have investors that you don't know or are not comfortable with, because investors become stockholders. They have fiduciary causes of action against you for acting improperly. So you want to make sure that they are partners with you and agree with the philosophy of the company and where it's going. But I always like to put a box around the amount of investors that we're going to go speak to, talk to them, get feedback. And it may be that box of investors is not interesting. You get the feedback from that box and then go to the next 5 investors, next 10 investors, using the feedback you got from the first 5 investors, and then build upon that till you get a term sheet. Every company's in the best way or the best position once they have a term sheet. You're even in a better position when you have 2, because frankly, that means that there's competition and valuation is probably going to be going up. But getting to that first term sheet is always the most difficult, and kind of, entrepreneurs get impatient. They want to know how it works. There's no perfect form to doing it, but normally I like to start with a few and then build upon those relationships and build upon the feedback you get from those investors. Once the term sheet comes, it usually comes from investors, although I've certainly been company counsel where I've drafted it and kind of proposed it, but most of the time it comes from investors, and then you want to go through those terms that we've already discussed. The negotiation of the documents is one piece, but by far the biggest time suck is diligence. And that is them getting comfortable with all of the IP, legal, business diligence, and that usually takes weeks, not days.
Eric, I got a quick question. Sorry to interrupt, but this is like important. Do you have, in your opinion, what is market? Data rooms open before term sheet or after? What do you recommend to your clients?
Sorry, do we put the term sheet together?
Do you recommend entrepreneurs send a data room prior to a term sheet or after?
When to open up the data room, Eric?
Yeah, I don't open up the data room. Well, at least I try not to open up the data room until we at least have confidence the term sheet is coming. If I can wait till the term sheet's coming, great. But if I have a data room that I need to open up beforehand because we're trying to work a process, then I'm putting a very limited data room in there, and it's not containing any legal documents. It's not containing kind of the traditional sense of what is in a due diligence request letter. It's some high level financial information that the company would be comfortable with, but I don't know who has access to that data room, and I don't want people forwarding access. So if you put a limiting factor that you're only going to 3 investors that you have personal relationships with, I feel a lot more comfortable than that. And I should mention to everyone on the phone that traditionally speaking, US investors do not sign NDAs, which is kind of mind-boggling, I know, but that is just the market practice. In Europe, it's the exact opposite. NDAs are a requirement before you would ever disclose any information in Europe for investors. But in the US, US investors have just gotten away with it for a long enough time where now it's become market and they just look at too many deals and they don't want to have to bother with the fact that they might have learned some information. And that's why I get a little more cautious, I think, with the data rooms. There is no NDA in place. And so you're really going on kind of handshake, word of mouth deals. And therefore I like to keep it behind the curtain as long as possible. That being said, you need to get them interested. And therefore some financial information or some business plan information needs to be given to the investor. And that's the only stuff that I think is really necessary. If they really have problems with the data room, once you open it up and see all these other issues, they can always walk from the deal. So I saw a question about, the outsource such founder challenges and make it easier for, well, yeah, I don't know if challenge is the word I'd use, because if the founder does need to have those relationships with the partners at the venture firms who are making those investments, because they will either be observers or on the board. And so with all my clients, I like to meet with them and talk about the investors that, at least in my mind, make sense, and that combine that with a group of investors that the entrepreneur is already thinking about or maybe already has relationships with, and find the right set of folks to have initial conversations with. And that's why I keep it small. And so we do a narrowing at the beginning. And again, there's a lot of lawyers out there who may do it differently. This is just how I work. The good thing about being in my profession is I see a lot of venture capitalists. I see a lot of deals. I know them. And so I think I do have a fairly broad Rolodex of folks who know, and the lawyer for your company hopefully does a lot of deals as well. And they know the company or the investors that are out there that are interested in your space. I'll also mention this, and again, I'm dating myself here. Back in the early 2000s, we didn't really have the internet as accessible as it is today to find out what investors are interested in, who's invested in what companies, what verticals are hot, what are not, who are going to be good partners. And so you can do a ton of that research online through the networks that you are already party to, whether it be CEO or entrepreneur networks or incubator networks. And so that's super helpful to find out who are going to be the good partners out there. And that's why the curation process for finding investors is not as crazy as it used to be. And you should work with your close advisors to figure out who would be the right match. I'll just finish this off since I know I'm over now. Closing, you should think about, and this is actually a great transition. So closing is probably 6 to 8 weeks these days. It used to be a little bit shorter, but people are doing longer due diligence for various reasons. But if you've got a number of safes and notes outstanding, you're likely going to want to go and get them to sign up. You don't have to, but you likely want them to. So you're going to have to go to those folks. You're going to have to go to shareholders to approve the charter. You have to get your board to approve. You're going to have to get the investors signed off on the documents. It's a long process. And that's why it comes 6 to 8 weeks is kind of a ballpark figure. They certainly could take longer, sometimes shorter. And then, post-closing, you got to kind of issue all the stock certificates, update the cap table. If you have subsequent closings, you can do that afterwards. And then, you have your first board meeting with your new board member or members. And then they can go, oh crap, I can't believe I invested in this company. I didn't know there were this many problems, but bad joke. But that's the first oh crap meeting for the board members when they come in. And it's actually usually a very exciting meeting because everyone's excited about the product. So that's a 68 timeline. I'm not going to go into term sheet basis because we've hit a lot of that, but I will redirect you to Cooley Go one last time, which has got not only the statistics and analytics that we just went through today in a much deeper dive, and you can manipulate the data depending on vertical and size of round and all of those things, but there's also, it's got to be over 200 articles now. I'm not sure about the right number, but for entrepreneurs who are starting companies, thinking about hiring employees, thinking about capital raising, thinking about protecting IP, all of those issues that you come up with that you're like scratching your head and you kind of just do a Google search, you don't get the great answers. Or maybe you do, but check out Cooley Go. It is free for everyone to use, and a lot of cool articles to help you educate yourselves. And then that way, when you talk to your corporate lawyer, it's a 5-minute call because you're already fully educated. It's not a 25-minute education call. It's a 5-minute let's answer the question call. So with that, I don't know if there's any other questions. Normally, I only talk half the time, and I get a lot of questions because people have a lot of different issues, but we got a huge group here today. And I've got a lot of good questions on the chat room. So Derek, thanks for putting those.
Hey,
through.
Eric, one question that I think Gary brought up is on CARTA and managing the cap table. Like, what is Cooley's recommendation around cap table management and using CARTA or something similar?
Yeah, I can't recommend a particular group, not authorized to do that, but I will say that they certainly are helpful, whatever group out there that you like, to use a resource that helps not only your executive team, but those folks who are stakeholders to get access and see exactly what they own in a company. And I have a lot of companies that just survive on that. There's every platform's got different benefits. The other thing to think about is every company or most private companies need a 409A valuation. We didn't get in that today, and frankly, it's a whole nother discussion, but that's another option that you probably want one of your service providers to provide and making that easy to use. But having an outsourced is cheaper, not using either internal resources or a firm to do it. It is a lot cheaper and administrate a lot easier. And there's a lot of great products out there.
Yeah, makes sense.
Yeah.
All right. Well, thank you so much, Eric. This was incredible. And
yeah.
I will make sure people know how to get in touch with you and Cooley. And like you said, Cooley Go is a great resource. I didn't realize it was so cool. I just assumed it was like a safe document. So it sounds like there's a lot that we
it is. It's super cool. And funny enough, I'm on it quite often myself, which says something even because I'm in the profession. So I love looking at the data and I love looking at market data. So yeah, encourage everyone to do that. And again, thanks, Derek, to you and your team, and Gary for having me. Really appreciate the opportunity to speak to everyone. And thanks to everyone who's on the call for making time for me today.
Yeah, thanks.
Awesome.
We appreciate it.
Thanks, Eric.
Thanks, Eric.
Take care of yourself.
Bye-bye.
Bye-bye.
All right. So everybody, the next step is there is a link inside of AirMeet. I also will post it in the different GSD rooms, but if you guys can just grab it real quick. And I'm going to head over there. And then what we're going to do is it's super easy. You're going to see virtual tables and Gary will be at one. I will be at one. Nick will be at one. And I believe Mandeep. Are you here, Mandeep? Yeah, if you guys can't attend, hey, think of this like networking after an event. So I know we only have 15 minutes left per the calendar, but if some of you guys will have to leave, some of you guys won't come, but we'll be over there at the tables. So if not, regardless, thank you very much. Thanks for coming. I think it's important that GSD connect you to people like Eric, but I also think there's going to be amazing people in that AirMeet. So come on over and join us. Goodbye, everyone.
See you. Bye-bye.